Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Well, hello, everyone. Thanks so much for being here and tuning into the Millionaire Next Door podcast. Delighted to have you here and hope you're finding value from these discussions. Today, I've got a terrific guest. I'm always trying to find great guests. I'm really excited about this one. Is Gary Sinderbrand. We worked together, or I knew of him way back in the day when I was at Merrill Lynch. He was kind of one of these OGs, and we used this interactive financial plan. He developed some of the software. We crossed paths decades ago. His office reached out to me recently, and I recognized the name, and we were able to schedule something. And we met ahead of time and just had a great discussion. So we have some really interesting stuff to go over we think will be worth sharing. And hopefully you find value. And thanks again for listening. So Gary, welcome. Thanks for being here.
Robert. Good to be here. Thanks for having me.
Yeah. You were you're out in Vail, Colorado, I understand, with a week left in the ski season. So
just about. And
good for you.
On our initial call, which is supposed to be 15 minutes, I kind of gave you the grand tour of everything from the base of Vail all the way out to where I live. And I drove you right into a storm, which was kind of interesting as well. So weather changes in Colorado a lot.
Yeah. So for the listeners, it is pretty funny. We had sort of an introductory Zoom to present for this, and Gary was where he teaches at Vail at this stage of his career, and he was coming off the mountain, and he kind of walked me through with his camera on the Zoom and ended up, well, here's the employee parking lot, and drove me out on this is that. And then he showed me sort of a storm we were going into that reminded me of the movie Twister, when you see that big dark cloud, moving it towards you. So we had a really fun time just interacting on the pre-call, but we're ready to launch into this one. And honestly, we're recording this. It is April 9th, 2025. There'll be some delay when this comes out because there's a few others we've recorded. So we never know. Markets are incredibly volatile, with the VIX just having to hit a number of 54. That's called the fear gauge. Interestingly, I did speaking of skiing, a discussion, episode 54, with Kristen Ulmer, one of the former professional skier, top big mountain skier in the world. Episode 54 on July 30th on the topic of fear. We weren't talking about markets. We were talking about life and skiing and anxiety, but there's an enormous amount of that going on. So before we launch, I just want to let folks know, certainly clients and others that are listening, if there's a lot of anxiety about what's going on, tariffs, there's other things feeding into this. It's not tariffs matter, but it's not just that. If you are feeling that, you come across someone who is feeling that, worry, concern about their retirement, please have them reach out to me. I'm happy to be a sounding board with really no obligation. This is more of a public service announcement. Unfortunately, I chatted all through my introduction to Gary. It's really time to turn it over to Gary. So you may have some thoughts on that, but please, Gary, welcome. And great to have you here at this time. Thanks.
Thanks, Robert. It's good to be here. When I saw initially the name of the podcast, it reminded me of a book I read, even I think long before you got in the business, by Tom Stanley, that described that the millionaire next door is not the one driving the fancy car with the big watch and showing it off. It's the one that's diligent, disciplined, does not live beyond their means, doesn't pick up a lot of debt, and just continues to march forward and kind of absorb things as they come. So the title of your show is, I think, is especially timely. On the topic of fear, I deal with it in kind of both worlds. I deal with it as a ski instructor every day that I teach, and I deal with it with the financial advisors I currently work with. And prior to that, it was the clients. There's a lot of biases that we develop over time from the client's perspective. And I'm sure you deal with this in your advisory role. You're dealing with recency bias. Whatever the most recent occurrences were are likely to continue. You're dealing with confirmation bias, which means that the algorithms that the social media companies use, they don't really care what you read as long as you keep your eyeballs on it, and they can show you an ad or two. So you're only going to read things that they already know ahead of time you're going to probably pay attention to. Fear of loss, fear of recognizing things that didn't quite work out the way you thought. And all of these things kind of work counter to what we're trying to accomplish. If I can start with kind of a skiing metaphor, I think I learned more about managing fear and uncertainty in my evolution as a ski instructor than I ever did as an advisor. Because there you're dealing not just by trying to overcome someone's mental and emotional biases, there we're trying to overcome physical fear. Like, if I do this, I am going to get hurt. And I deal with people on the mountain that are successful by definition, or their families are successful. They didn't get to Vail. It's not free. It's one of the most expensive places to come and ski. The amount they charge for lessons to me is extraordinary. I try and be worth it. They don't, of course, we don't see that. We're paid hourly, but I never lose sight of the fact that the people that are coming there are successful in their own right. And what's happening is that their natural reaction to change is to not do the thing which lowers their risk of getting hurt. It's to do the thing which increases their risk of getting hurt. Quite simply, their brain is telling them that if they sit back or lean against the mountain when they're turning, that since they're closer to the ground, that's safer. When in actuality, you're hitting the gas pedal and putting Isaac Newton in charge of your run. Because the opposite is what you have to do, which is basically get the fronts of the skis on the snow and be able to bring pressure to the proper ski in the proper amount at the proper time. Now, you can talk that through and explain it to people, but getting them to actually do that is a challenge. They know they're doing it wrong, and we kind of work through drills until they can start to experience the feeling that they're going to get if they do it correctly. So the only way we overcome that physical fear is to progressively, in a nonlinear fashion, educate them so that their muscle memory begins to take hold. But we can't just say to everybody, we're here and we're going to go here and that's it, because everybody's different. In my other role, both as an advisor and now as a consultant, trainer, coach, whatever you want to call it, I bring that front and center, because advisors, as you well know, are not the easiest people in the world to convince of anything. Our role as an advisor is to act as the bulwark, is to act as the wall between the products that your company or that you have available to sell and what the actual needs of your client are. And that's, again, involves an extraordinarily high degree of trust. You're dealing with successful people, but you've got to overcome their natural, I would say, suspicion or fear that the recommendations you're making are in their best interest first. And you'll do just fine as a result. If you recall from Merrill, the plaque in the front of every office by Charlie Merrill, the words that basically Merrill Lynch was founded on, the interest of our customers shall always come first. All right? As a 24-year-old kid, I took that to heart. I really did, which is why after my first year, when I blew up more people than I helped, I didn't think the job was right for me until I really took those words, internalized them, and changed, and started to figure out I'm dealing with people that are naturally skeptical, clients, prospective clients. They're in a world they don't really understand. They'd like to, and they're going to trust me, a 25, 26-year-old kid, to guide them potentially over decades to come. And I understood the risk they were taking. Now, for most people, they would start with a value proposition. Here's what we do. Here's why we do it. Here's why our analysts can beat up their analysts. We have great research, blah, blah, blah. But most financial advisors that work at large firms don't stop for a moment and think, you're working for a buy-side firm. You're not working for a firm that's going to tell you not to do something. You're not working for a firm that's going to tell you that maybe the market's a little overvalued at this point. maybe you need to adjust away from the asset allocation you're currently following. And as a result of that, it's a very product-focused business, at least that I grew up in. What I recognized early on was that the product or the solution set didn't matter. What really mattered was figuring out exactly what needed to happen to the extent that we could, talking over long periods of time and gaining a profile of a client, enough information from a client to be able to identify where they were currently, where they wanted to ultimately go, and what are the likely things to happen between those 2 points. As you recall, we used to call that the A to B approach. I use the letters A and B. I figured I wouldn't forget them. And that's what we taught. So we taught a process that involved an absolute data dump of knowledge of who the prospective client was, and then testing using initially the software you mentioned, the Interactive Financial Foundation, which I know I'm going to date both of us here. We used to get on a 3¼ inch disc that we'd slide into the side of a machine that barely had the memory to handle it. But it was a really great tool because we could put the ultimate goal in. We could put in the intermediate goals with little buttons we could turn on and off. And then we could put in the expectations of return that we would expect from the equity market, the debt market, cash, and inflation. And basically, we could come up with a recommended asset allocation, which was based off of a planned outcome. And that was really the leading edge of the financial planning that's happening everywhere today. So once I could educate my clients, which I always did and still recommend to my advisees that they do, I would use a document that I would continuously update called a resource book. And the resource book was mostly charts and graphs. There was some verbiage in it. There was some commentary on things that really defeat people, things they have to watch out for, maybe 14 to 16 pages. And I explained to my prospects, this is what I do. If you hire me, you have to understand this is what I do. As long as you are completely open and honest with me about where you are and where you want to go, I'm in. But you have to follow my guidance. If you don't, I can't guarantee I'm going to get you where you need to go. And I would put certain things in markings on a chart. For instance, I would look at a market timing chart, and I would explain to people how there may come a time when they feel it's really appropriate to go into the market because everybody else is doing it, and they want to increase their allocation to it. And I would explain that you're having an emotional response. Your thoughts are being confirmed by your friends. And to my way of thinking, if everybody's invested, who's left? Who else is going to invest? So you want to make a little mark on that. I would also plot the rate of return that the client would need. Let's assume it was 6%. Well, to me, that was about a 50-50 portfolio. I know equities long-term supposedly make 10. I know what all the analysts say. I know what they put in the rest of it. I always liked to underpromise. So I used 8, 4, and 2. 8% for equities, 4% for bonds, 2% for cash, and inflation. Now, it wasn't predictive of a straight line because markets don't move in a straight line. They're nonlinear. But it kept me out of overweighting and basically allowed me to get through, even though you, in your personal career at Merrill, missed the dot-com bubble. I got that one. 07, 08, 09.
Oh, I was there for the dot-com bubble.
You were there.
Yeah, that was 2001. Yeah, I was there.
Okay.
Yeah,
they say wisdom arises from reflection and experience.
And I think got to enjoy 2008, the mother of all of them. But any rate,
so
when Merrill Lynch went away overnight, but
they were on the way out. That's a whole other story. I was kind of
we're not going to go there.
I wasn't in the room, but I was next door when that happened. But in 2007, 2008, if you remember what the equity markets did, the 5 years coming up to 2007, 2008, remember some of those numbers? 3, 4, 5 positive standard deviations. So if I had a client that I was basically managing to a 6% return, and 4 years prior, we had averaged a 25% return, and I had a 15-year timeline left, I didn't need a 6% return anymore. 3.5 would have done just fine. So in 07, early 08, I moved back to my lowest equity allocation ever, which was 35%, which if you recall the efficient frontier, that was kind of right at the knuckle of the frontier, right at the belly of the turn. where if you added bonds, you picked up more risk and less return. And if you added additional equities above that, you would pick up additional return, but your risk vector would go up as well. And clients were not happy. And I made them turn to the page in the resource book that talked about the majority of your return is going to come from how we allocate your assets across markets. And I said, if we get overweighted, the question I'm going to ask is, if you walked in with that amount of money today and I told you to put 65% of it in equities, would you do it? And they hem and they haw. Well, probably not. Well, that's where we are. So we're taking our gains. We're moving over to bonds. To a large extent, rates were high back then before the Fed crammed them down. And I came through 07, I came through 08, average client was down about 4%. And the clients basically said, well, you weren't wrong, but you were early. Now, if you want to try and explain the future value of money you take, it's got a longer timeline. It doesn't need as high a rate of return. Most people started to see that in their results. And when that market cracked and hit a low in March of 09, always remember the S&P. You remember where the S&P bottomed?
666 maybe.
There it is. You're a student of the market.
I remember my first call from someone in March of 09 that wanted to buy a big blue chip when it was down. And it was like, I mean, I was like the Maytag repair. No one was calling. And I was like, could you repeat that? He was a professor at USC. So he wanted to buy, I think, B of A or something at Bank of America at $4. But I was like, that's probably, but I was like, you're the only one calling to do this. But things moved. But I will never forget that call.
Yeah.
Obviously, it was brilliant. But yeah, it was washed out. It was overdone. Yeah.
Well, the calls I made followed this very strict asset allocation policy that when I got more than 10 points variance, if I started at 50-50 and I had one thing at 65 and the other at 35 through market movement up or down, that trigger was banging away at me saying, you have to rebalance this. And it would also apply if it went the other way. So I rebalanced away from equities, and I was lucky because I just stayed with the discipline I'd always believed in. I rebalanced away from equities through most of 08 and even late 07. And then when we got into 09, my equities had dropped from a 35% allocation through just depreciation down into the mid 20s, which was too low. And my bonds had appreciated. I started reversing the trade. Clients were fearful, concerned. It's going to keep going down. I said, well, if it keeps doing what it's doing, a year from now, we're either going to be talking about ammunition and fresh water, or if we stay with the discipline, there's a good chance we're going to look pretty smart. And those were some rough calls. That phone was heavy, but most people listened, and we came roaring back. As you know, the market bottomed in March and ended up moving back up and somewhat normalizing as the Fed stepped in aggressively. And by the way, most people don't know this. I'm sure you know this. I don't know if all our clients know this, but the moves that the government made paid them multiples of their initial investment for their bailouts. So there was fear, but there had to be action. You can't just freeze. And a lot of the reason I was able to get my clients back into equities at the right time was because I'd preconditioned them and I'd educated them. And I kept that constant mantra up. This is what we do. As long as our target stays the same, we're going to get there. But this is the discipline we have to follow. Somewhat similar to what you're dealing with today. If you were to ask your client, any client you have, to give you the average return on equities over the past 5 years, do you think they'd know?
I don't know that they would know. People expect a straight line thing. It really moves all over the place. And because of the last 2 years, they may be skewed to thinking it's much higher than it is. I don't want to break your stride, but just real quick, you brought up a couple numbers just for perspective, because of where we're at. You mentioned March 2009, the S&P 500 was 666, right? Kind of an ominous number. Okay. It hit, now it's at 49.86. This is after a pretty severe and steep correction where it hit about 61.44. It moved from pretty overvalued to maybe fairly valued. but that's still enormous growth. Or the
Yep.
people concerned, my Apple went down 10% in the last week. I'm like, okay, you were up 1,184%. Now you're up 1,174%. So some perspective. I'm not saying, but they do go up over time. People need to know, okay, I'm 2 decades older now. Maybe I have a different time frame. Those all need to be factored in. But I sort of just cut in where you were going with the story. But those numbers, the 666, as bad as it seemed, the beginning of the end, they'll never come back, to 4986 is not a bad, that's a giant wealth builder, and the deals that you're talking were struck. I remember, Warren Buffett came on the air saying things are going to be okay. The government cut him special deals where he could get like 11-12% in Bank of America stock, or he made a fortune because he stepped in, and that was needed. But it's interesting when you see that perspective, and what you're getting at is this discipline, or that, we have what I call an unemotional, objective, rules-based process. We really walk people through things. I mean, in the most recent time frame, you saw everybody pile into 7 stocks. We got so overcrowded in the Mag 7, and now everyone's talking tariffs, and that is a big deal, and they do matter. But we've had a lot of this deep seek thing went on. China, now they can do it for about, you got to trust what they're saying, even though it's skeptical. That's changed it. You had the hyperscalers making announcements of $100 billion of investments in AI from a pretty asset light tech, rich type thing. That's changed a lot of dynamic here. So that's partly why we've had a pullback or fair value. But I kind of broke your flow there. But I think what comes to my mind is when you have this, when you've lived through .com, you lived through '08 that was caused by enormous excesses, right? You had the government artificially pushing down rates for 18 years and just crushing savers. They've just stimulated after '08, and they did the same thing with COVID, and we really haven't paid a price yet. So we're going through that. I just went off on a huge tangent there, but that's what's going on. And I think that's what's on people's minds. And it's not just the tariffs. I just heard an incredible, this is not to take sides, but apparently the fastest growing economies, India, Korea, and I forget where else, maybe they're doing tariffs to equalize things, and they're growing fast. So things are not often what they seem. We give people the perspective, sort of this process. But hey, back to you. You were on a great roll, making a really good point, and I just interjected a whole bunch of stuff. But those are things that matter that people need to hear. And the other thing I did just want to comment, we don't really sell products or anything. There's none of that. It's evolved throughout my career. It's all about our process. Everything is purely advisory. That's what people pay us for, the pure opinions, the discipline. If you're a doctor and you've done it over many years, you just see cases and cases and cases. You're trained in medical school, but when you've seen 10,000 cases, you develop sort of a encyclopedic experience of, hey, I'm used to looking at these things. In my opinion, it's not always perfect, but we're probably going to be fairly close and try and give people fair perspective. So, anyway, long-winded chat there. Back to you with where you were going. But those are a number of thoughts. I just felt compelled to chime in because
No,
you
that's fine.
got my brain ticking. Yeah.
I can't argue with any of them. But one of the things I pay attention to is what I'm not reading, what I'm not seeing, because there's always an underlying story. There's always an underlying theme. Every correction, there's a little news blip that people claim this is what happened and here's why. And this will be no different. So there's a lot of noise around money. There always has been, much more so than there ever has been because of the 24/7 access we now have. And stories can tick in and tick out literally within a microsecond in a news cycle. So to be able to depend on that and rationalize and explain what happened after it's already occurred, I didn't find a lot of use in that because to me that was noise. Because I could rationalize both sides of it right now. Your comment, for instance, on, well, these other countries are leveling tariffs against us. Well, great, awesome. We don't export to a lot of those countries. There's nothing people in Madagascar, which is the world's largest exporter of vanilla and one of the poorest countries in the world, we slapped a 50% tariff on that because of the imbalance that we buy a lot of vanilla. We like vanilla. Well, people in Madagascar don't have enough money to buy anything from us. We're not exporting flat TVs to them. We're not exporting iPhones to them or whatever else the thing might be. So I look at the math, I look at the story that's told, and I have to discard it because to me, it's noise. Do I disagree with what's happening right now? Yeah, I probably do. Am I going to get into a political argument with my clients? Probably not. So I look at it differently. Assume you had a client that you took on board in 2020. Client gave you $1 million and they said, look, Robert, I just moved from this company. I'm rolling my 401k. I got 25 years to work. Can you turn this into $4 million at age 65? And you run your Money Guide Pro, whatever you run, you go, yeah, we can probably do that with an allocation of around 50-50. And you show the graphs and the whole thing, and it averages out to maybe a 6 or 7% return. And you educate the client that over time equities outperform. The longer period of time you look at, the higher the probability is they outperform. And where are they going to be? They're going to gravitate towards the mean. That's how it gets there. So then you're off and running in 2020, and you've got fixed income, which was still kind of low back then. Usually I would take 4, so I took 3. And you had equities go up 18.5%, and your 50% of your debt went up 3%. Your total rate of return was 10.7. Now I'm already ahead of projections by almost 5%. But my allocation is only 45-55. So under my old rules, I would just sit and think, okay, fine, I'm not going to hit the button yet. Well, in 2021, equity market goes up 28%. That's when the market was getting flooded. You had no place else to put your money. Rates were long-term bonds were less than 1%. So total rate of return on that allocation without rebalancing was 16.75. At the end of that year, that allocation that started 50-50 was now 40-60. So I'm way ahead of the game. So then I recompute, well, what do I need to hit the target? And all of a sudden it doesn't come out to be 6.5%. I just need 4.8%. So I make a call. If that were my client, we're rebalancing. Why? Because we're way ahead of the game and we don't have to keep sprinting. We can go at a fast walk right here. So let's rebalance. Okay. I don't want to. Leave it where it is. Everybody knows it's going to keep going up. 2022, the market gets hit minus 18%. And the client calls and says, I should have listened. Let's do it now. And I say, no, because we're back at 45-55. We're back in the zone where I don't rebalance. We're going to sit tight. Subsequent 2 years, up 26% 1 year. In 23, up 25% in 2024. And through April 4th, even with a minus 13.73% decline, I am still way ahead of the game. And I don't need a 50-50 portfolio because I've made more than I ever anticipated, inclusive of what just happened. So I can rebalance that portfolio to 45-55. Take some risk off the table. And bonds, by the way, for your listeners, hopefully they know this. If you own a bond mutual fund and it's got 5 letters, call Robert so he can get you out. Because, Robert, if you remember, we used to talk about fixed income in terms of permanence and definition. Remember that?
Yeah, 100%.
If it doesn't mature and you don't know what you're going to get paid, it's not fixed income. And in open-ended bond funds, you're just inviting everybody else to share with you whatever happens. And unfortunately, when people are afraid and rates are being aggressively lowered, they pile money into these things and you suffer dilution because you end up with weighted average coupons far lower than you started with. So your dividends go down. When rates go back up, your net asset value goes down. So if you're an investor and you're listening to this and you've got one of these things, ask your advisor when it comes due or what it's going to pay. And if they don't have the answers, call Robert because he'll put you in a real bond because you can't make any money in bonds, but you can sure lose it. So that was one of the central core things we did. We needed to know what was going to work. If I wanted uncertainty, I wanted to get paid for it. So my point is that if you're consistent in your discipline and you stay away from trying to render opinions on the news, and you look at the signals the market's giving you, you will always get where you need to go. So one of the things that I've been doing for most of my adult life is I'm a pilot. I fly small airplanes. I haven't flown in a while, but I'd love to get back into it. And I have a fair amount of time. And in aviation, we work with a concept, because you're always on the radio constantly, called signal to noise ratio. And sometimes you'll hear in a movie, how do you read? And they'll say 5 by 5 or 3 by 7, whatever it is. 5 by 5 means that your signal basically is coming through loud and clear, and there's very little noise. We work in an environment that's almost all noise. And it's every day and it's all the time. And we have to respond to it. And we have to manage people off the ledge. But what's the signal that we're really looking at? This whole tariff thing, it's a zero-sum game. It's idiotic to even discuss. The formula, the rest of it, I can look at it agnostically. I can look at it in a very technical manner, and it just looks like lunacy to me. Now, what matters more is how people react to that, what their perception is. And I think our role as advisors is to help them manage that perception relative to their goals and needs and wants, not just tomorrow, but for the rest of their lives, the rest of their families' lives, and keep them focused on decisions which completely rely on signal as opposed to the nonsense we're picking up every day.
Boy, I 100% agree. That is so, the process I use may be a little bit different, but it really is all about the process. And I want to dive into that a little bit. Interestingly, where my process evolved, I call it our process, objective, unemotional, rules-based. We're really looking at the data. And interestingly, the team or the guy who taught me that, you mentioned being a pilot, okay? He's a super OG guy, but he's a brilliant guy. He sold his company. He was an instrument trained pilot. So he's looking at instruments for his, and he explains, I guess when he was an early pilot, he was flying from somewhere down to somewhere in Mexico, and he was not using the instruments. He thought he knew where he was going, and he went a couple degrees off course. So at any rate, he had to land his plane in the middle of a field somewhere out in Juarez, Mexico, because he was about to run out of gas, because he wasn't looking at the instruments. He thought he could go out here, make a left, and he'd be fine. Well, it didn't work that way. And I've explained a lot, if you're with the financial planning, if you're taking a longer flight, like your life or retirement, if you're flying from here to Asia, if you're 1 degree off course, by the time you get out there, you could be 1,000 miles from where you want to be. So you really got to follow the instruments and the signals. And we're very mic'd up through some software that's incredible. It used to take a team of 200, of like 10 guys the entire week to analyze 200 relationships. Now they do 39 million overnight through software, and I'm trained in the system, so I get the feedback and the data, and I can see the outliers. So, by the way, where people are getting their news now is incredible. Just all the articles they're sending me, they're coming off Twitter, off Instagram, off, I'm blanking, what's the one that the Chinese own, or we're just dealing with the giant TikTok. Yesterday there was tariffs going, giant quote fake news event. So a huge seminal part of the process is really sifting through the noise and trying to get to the signals that truly matter. And, we also look sort of a lot at concentric circles, things that matter to clients. That's really important. Think of it one circle. Another circle is things we can control. And if you think kind of like the Olympics, those interlocking, the circles, right? Where those two intersect, if it matters and we can control, we focus everything there. That's what we're looking at. If it matters, but we can't control it, it's not to say it isn't important, but we can't control it. If we can't control it and it doesn't matter, we don't care. But where those intersect, so I would say an enormous driver of the process, and really the heart of the process, is helping people understand what's noise, which is most of it, and realize we're in a system that's designed to create enormous noise. And most people just listen to a quick little soundbite on Fox or CNBC. It's 30 seconds, 60 seconds of an interview. You don't hear the full thing to put all the context into it. look, they're not going to tell you everything's great and it's a wonderful day and there's no news here. Okay. I'm in Pasadena, California today. It's about 80 degrees. It's a nice mild day. If I told you nothing's going on, no one's civil rights are being violated, there's some birds chirping, it's a pretty nice day. I mean, you're going to turn that, you're not going to buy that newspaper or tune in. You're going to tune out. If you told me there's total mayhem, it's blood in the streets, they're going to follow that. So there's a system designed to do that. And so we're there to kind of sift through and say what really matters. On your rotation, you talked a lot about these percentages where people were drifting from their target allocations. Again, to what I was saying, there was a giant rotation away from the S&P 500 to just 5 or 7 stocks, way overdone. All the values, 493 of those things they didn't care about for a long time in the last 2 years, in 23 and 24. We would have said, and we did say, rotate back to some value, and we're seeing that happen now. But the point is, that's a discipline, and you have to have somebody watching that. And the essential part about a discipline, I think we're really saying the same thing. I'm just explaining it a little bit differently. You have to have that discipline. And if you don't, and you don't follow it on a consistent basis, it's the same to having no process whatsoever, basically flying by the seat of your pants or being that untrained pilot who's just flying the plane without following the instruments. The instruments are there for a reason. And when you get on a commercial aircraft, they go through a big pre-flight, all this stuff they check, and they make sure it's all thumbs up, good to go, right? And that's a process. And occasionally they add a new little step to it for one reason or another. But we follow that kind of a process. And what that does ultimately in the end is just stack the probabilities much higher of having much, more success. Doesn't mean we're right all the time. And sometimes you can stay wrong for a while, but we are looking at stuff. You mentioned a 5 standard deviation move. Well, we're seeing everything on the bell curve. Is it a 1 standard deviation? Is it 2? Where are we at? Are we in the middle of the curve? Are we way skewed to one side or the other? We're pretty skewed to one side right now. Doesn't mean it couldn't keep moving further from 2 standard deviations to 2.5 or 3. But if you understand the bell curve, and I have folks who are engineers, or maybe they just took probability and statistics, they know what that means. It's pretty extreme. And there's a pretty strong probability it swings back in the other direction eventually. But it's walking people through that, having an anchor, looking at their longer term goals. The Millionaire Next Door, it's kind of the overnight 25, 30-year success story. We're here for the long run, not the people's attention spans, and where they're getting their news is just absolutely crazy. So we're there to be that voice of reason and walk them through the process. And I would hope our best clients and folks they work with me because they like me, they trust me, they trust our team, but it's about the process ultimately. No one's a rock star or a genius here, but we've developed a process and we follow that process, and people hire us to follow through on that process and share it, make it explainable, but help them make good decisions. And I look at it a lot like a doctor or medical team. I mean, some of the process, just for analogy, it's like a blood test. Okay. You run the numbers. There are your numbers, or you run there's the data. We're not guessing, we're looking at data. So I see so much similarities that just really got me enthused. And then folks who come to me, I walk them through a process. Or if I just got introduced to someone yesterday, they're both dentists on the East Coast, a husband and wife team. And so I'm reviewing their whole current accounts, but really through the process. And I know I will share with them stuff that they just don't know. They're not equipped to understand. And I tell people who are coming over, if they have an advisor who has a process like ours, or a very disciplined, rules-based process that's highly evolved, they'd probably be crazy to change over. If that person doesn't have that in place, they'd be crazy not to change. They have to have that process. So it's a big dynamic that can get lost in, hey, what do you charge for your fees? What do you do? Well, the value is immense, and you do start to see it in a time of more stress, more crisis. People start making decisions out of fear, out of some news, out of what someone said. And there's an awful lot of that abounding, probably too, being a pilot, right? If you're flying into more inclement weather and things are going crazy, you really want the guy who's following the process, right? I mean, I think of who's the guy? Was it Scully? Who was the guy who landed the plane? Sullenberger, that guy apparently, as I'd heard during his breaks, everybody would take a break as a pilot. That guy would go study these manuals for processes in his spare time. And then lo and behold, it mattered and he pulled it off, right? But he later got sued by the airline, by the way, and let go. But he did do a miraculous thing and saved a lot of people's lives. So, boy, you were the guest. I ended up chatting a whole lot. But again, I got so enthused by process and keep going. And then we're going to start to kind of land the plane as a euphemism there. But we should totally do this again with a part 2. But yeah, what else do you want to share that maybe we didn't cover? Did that get anything going for you?
I could unpack a lot of what you just said. And interestingly enough, one of the things that I always did with my prospects and my clients was I created space, and I called it riding the silence. Everyone hates kind of that pregnant pause. So I always found that if I could just really listen intentionally and kind of catalog what I'm hearing, look for repetitive patterns, look for new information, coming back and just kind of putting together, maybe with a little bit more concision, putting together what I heard from the person I was speaking with, not only shows I was paying attention, but that there may be some new knowledge there, some concepts I didn't consider. I was particularly taken by your metaphor of the guy that was flying in Mexico. And he was flying. Mexico is renowned for conditions that are called CAVU, C-A-V-U, clear air, unlimited visibility. So it's easy to get lost because you're probably just looking at desert. And even though you might be flying on a particular heading, following your compass, what you don't know is that there's probably a crosswind that's moving you to one side or the other. And the further you go, the further off you're going to be. That's happened to me, so I recognize it. One quick story, when I was getting my instrument rating initially, unlike what most people were doing, which is doing most of the work in simulators, I waited, and living in New Jersey, you get these northeasters from time to time. I waited for a northeaster in the fall and went down and climbed in the airplane with my flight instructor, a 66-year-old ex-IBM engineer who'd been flying, I think, since he was 2. And up we went, and we're in the clouds, and I couldn't see a thing. And so it's called actual instrument time. And I start looking out the window, and I can't see anything. I'm looking up, I can't see anything above me. I looked down, and I noticed one of the instruments called an HSI, a horizontal situation indicator, which is supposed to be like this when you're straight and level, is going like this. And I notice my vertical speed indicator, which tells me if I'm climbing or descending, is going like this, and then it's going like this. And the plane's completely out of control. And my flight instructor is just sitting over in the right-hand seat like this. He's not moving. And it's sweat. It's literally, I don't know if I'm sweating up because the plane's upside down. I don't know where the hell I am. And he just quietly says, go to home plate, fix it, and move on. And those were the trigger words. That was the discipline. Home plate, HSI in the middle. All right, fix this, fix that. There's 6 instruments that you look at. And I got them all lined up. A couple minutes later, we burst out into beautiful sunshine. And in a very laconic way, he said, I could be home watching the Eagles game with a bourbon instead of screwing around up here with you trying to kill me. And I was like, I was a mess. But that's the right, I had vertigo. That's the rite of passage you have to go through. You've got to overcome that fear and focus in on what matters the most. And it was something I never forgot, even at times where I had a couple emergencies I had to handle, knowing that slow down, take a breath, work the problem, stay within what your training has been, and you'll come through. What we do as advisors, exact same thing. And I agree with you. Any process that you apply consistently is dramatically better than just making it up and guessing. when clients would call and say, I just heard this on CNBC or that on CNBC, I say, do you know why those people are there? And I just saw it come across. Fearless Leaders just announced a 30-day pause on tariffs. I guess they probably went long the market this morning. The reason that there are people on CNBC talking all the time is they need to show you something between the commercials. But the questions I would ask when somebody said, this person says this person says that, my response would always be, assume you really knew, you personally, what was going to happen tomorrow, the next day, next week, next month. Who would you tell? And that ends the conversation, period. They're ordinary people trying to do extraordinary things. I'll share one story I think we both went through to give you an idea of how fear can not only create insanity, but it can also create extraordinary opportunity. Well, if I say the name Meredith Whitney, does that ring a bell?
Mm-hmm. Mm-hmm.
What was she famous for?
Wasn't she the CEO at eBay? But she had some major blow up, or who? You tell the story. That's what I thought it was.
Meredith Whitney was the only analyst. I think she might have been in Drexel.
Oh, yeah.
She called the banking failures. She called the bubble in mortgages. And she got paid. She was on every television show. She was everywhere. Do you remember what she did next?
Yeah, she was right early, but no one listened. But what she did next? No, go ahead. You tell the story.
Sometime in the spring of 2009, maybe the summer, she came out with a prediction that based upon her analysis, every municipal bond, no matter what, was going to declare bankruptcy and be unable to meet their obligations. It gapped the market. There were no buyers. And I think long-term bonds, 10-year call protection jumped from like 4.5 to like 6 in 2 days, tax-free. And I was always very, very heavy in the bond market. I understood it. I had great outside bond managers. I couldn't thank her enough. We made more money on that trade where we were buying bonds at 6% handles, 10-year non-call at 90 cents on the dollar because there were no buyers. And we traded them out probably for 30 or 40% returns to rebalance the asset allocation. So here's a woman that was right once, like a stop clock, tried it again, and then it came out afterwards that she was an investor and director in a hedge fund that was short the muni indexes across the board.
Yeah, gigantic conflict of interest. In a former life, by the way, I used to work in municipal finance, and I was trained as that and would look at muni bonds and crunch through numbers. So yeah, that's obviously what everyone's going to go under. But the fact she was short, wow. Did she ever was there any accountability, or did she ever? Okay. Well, here's another.
Nobody went to jail on that one.
So we provide the perspective. I remember, in 2009, at the extreme worst of it, one of our favorite CNBC guys, Jim Cramer, right, literally went on the air and said, whatever you do, don't buy another stock for at least 5 years. So, these things are said, this noise, and then it sort of goes away and there's no review or accountability. And a lot of people probably acted on that, and to their detriment. So, we're providing the counsel and the discipline. What you're talking about, the guy flying that was exactly what he described. A perfectly clear day, by the way. So you got that spot on. And you made me think of another time I was skiing at Snowbird with a friend who was a very, very good skier. It got very white out conditions, and we kind of had to just get our way down, and he sort of lost it with, I was aware that you could get disoriented very quickly. Where you're skiing on a mountain, you actually can't tell what's up from down.
That's true.
So why it's important to ski with a partner, but I realized he was going through this, and okay, one of us has to keep our head and get him to the lodge. And so we got him there and it was fine. And then about a half an hour later, he wanted to go ski a black diamond thing. I said, hold on a minute. You need to sit here for a little bit, have a lunch, get your senses back. And then it was all fine, but it's a good thing we had a partner there or someone to watch. And that could have been me just as easily. You could lose it, but you had that instructor who calmly had the discipline to say, here's what to do, follow that. And he did at the end, right? He told you, like, my God, I was practically having a heart attack, but I was calm enough to work through the process. It's kind of sometimes the role we a little bit how we feel. Wow, that is I love that. That is so resonating. But those are the things we walk through. I've been doing this 27 years now with second and third generation clients. You've been doing it how much? A decade longer? I don't
Yeah,
know.
probably. Yeah. I mean, I went into production in 1980
Okay.
initially,
Yeah.
May
So
of 80.
yeah, all that experience matters, but and in the process. Any quick closing thoughts? But I want to be respectful of your time and the listeners, and then I'd love to do this again because I think there's a lot of other stuff. Please like and share this if you think this will help with anyone. And again, repeating my public service announcement, if anyone is experiencing anxiety or just concern or worry, or they want a second opinion from a process standpoint, I'll be happy to do that for you as a sounding board with no obligation. I just want to, I know there's a lot of anxiety out there. So
Yeah.
it's
So
like,
I would be a little bit more direct, especially if I know it's an advisor that knows their stuff and is going to put the interests of the client first, as most advisors don't. We haven't had a chance to really discuss, I think, what's going to be somewhat of a cataclysmic shift in the experience level of the average advisor. This is a problem I focus on in my own advisory practice because your generation of advisors, and you're kind of younger in that generation, but about 40% of advisors right now will be hanging it up in the next 10 years. They control approximately $15 trillion. This is just, by the way, in the major broker dealers, the four major wirehouses. You look at the RIA space, the demographics are the same, and the numbers are probably somewhat similar. But the next generation isn't ready. They didn't go through what you went through, Robert, when you had to build your book and you had no idea if you're going to be employed next month, or what I went through with that pit of the stomach, trying to figure out how do we balance all of these things together and build a successful book. So there's a number of things occurring right now. There's a lot of advisors that have under contacted their clients for a very long time, that lower tier of the book that was important when you brought them on board. Well, they're not hearing from their advisor. If you're a client and you're not hearing from your advisor on a regular basis, not to talk about the market, but just to find out that they still know you're alive, you probably know their advisor. Clients I cared about, I usually contacted a minimum of 9 times per year. I do one intermediate review, one year-end review. The other 7 calls, how's your family? I've been thinking about you. Where's Julie going to go to school next year? How's the dog doing? What happened with your cat? That's the level of interaction I had with my clients. As a result, I never cold called. I had referrals from people I cared about who knew I wanted referrals. If you're a client, you're an investor, and you haven't been proactively hearing from your advisor, even before all this volatility started, but now you're getting calls or you're even calling them, that's an advisor not doing their job. It's an advisor that probably has too many households. They're not focused on your needs, despite what they said when you started. Maybe you were their largest account 20 years ago when you gave them $500,000 to invest. Well, now their largest account might be $50 million. And maybe they're too tied up with them, although usually that's not the case. But if you don't feel like your advisor knows who you are and can't give you the feeling that you are the only client they have, why would you continue to deal with them? So if you're a client or an investor and that's not happening, you want to ask, what's your contact frequency? How often can I hear from you? What are we going to talk about? And you have to hold to that, which is why advisors that have these books with massive numbers of households, they're just a mess. And they're not gaining any traction with their next generation either. So there's a lot that's going to happen in this business. Oh, and the last thing I'll leave you with is clients, as they approach their 50s, have a strong bias to fee for services arrangement. As they are in their 60s, they pay less and less attention to what that number is. So you're going to pay a fee and you're not getting value, go find a better person. because the value you get from using a good advisor will repay you in multiples down the line.
That is so true. A lot of the value is in that process. I agree 100% on the outreach. I do just want to say, I mean, I want to spread a little kindness or benefit of the doubt. You should be hearing from them. I tell my clients, God forbid, if you, for some reason, you don't hear from me and there's something going on, I'm trying to reach out, but please reach out to me. I had one, I was trying to reach a doctor. He's a cardiac surgeon. We hadn't connected for a while, called me last week. Turns out him and his wife both had a pretty severe COVID that laid them up for about 2 months. So my point is, sometimes I don't know what's going on with, there might be something way more important on a health or family where they put it on the side. So please, I just want to say it's a partnership. So please reach out to your advisor, to me as well. If you're just not hearing from them or you're not on their radar, that is not good. That's what you're saying. But God forbid there's anybody that I haven't reached recently that's wondering, please reach out to me as well too, just like your doctor's there for you, but sometimes you have to let them know too, hey, there's an issue going on. So I just wanted to state that. Gary, thank you so much for being here, for sharing your wisdom, your time. I would love to cue this up again, and thanks everyone for listening. Again, please like and share this. I think this is a very, what we call kind of evergreen recording. This is going to be just as pertinent and as valuable a year from now. So share it in the future. Thank you. Please make it a great day. Thank you, Gary. And it's great to have you with us.
Thanks, Robert. I really appreciate it. And if public or other advisors want to learn more, they can find my podcast on most of the major channels. It's titled If the Public Only Knew, and it focuses on advisors and clients. And I talk about a lot of the things we discussed today. Robert, thanks so much for inviting me on.
Oh, for sure, Gary. Yep. And we'll have some complete show notes with Gary's contact info, my info, if anybody needs to reach out to either one of us. So everyone have a great day. Stay safe. And we appreciate you listening. Have a great day.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors. Signature Estate and Investment Advisors, LLC, SEIA, is an SEC-registered investment advisor. However, such registration does not imply a certain level of skill or training, and no inference to the contrary should be made. Securities offered through Signature Estate Securities LLC, member FINRA SIPC. Investment advisory services offered through SEIA LLC, 2121 Avenue of the Stars, Suite 1600, Los Angeles, California, 90067. Telephone number 310-712-2323.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.